I'm transferring title, but I'm keeping myself on the hook for a mortgage.
Everybody going into the deal has the best intentions, but let's say that we'll just use a proverbial bus. You get you're the investor, you buy the home subject to, and you step out and you get hit by the bus. You're no longer here. What does that seller do? They don't have legal title. They don't have possession anymore, but yet they have obligation and liability on the mortgage. They're in a really bad spot.
Hey out there, everyone. We are back on a phenomenal series right now. Hopefully you guys have seen the previous videos below. We're going to go ahead and drop the link. We're on the Subject to Real Estate Investment series, guys. One of the coolest strategies out there that literally no one knows about. So we're going to continue to feature that here on the channel here, of course. Today we're going to play a little bit of a different role. So we've been an advocate for it. Now today we're going to play devil's advocate. So there's always going to be a flip side of the coin. There's always going to be pros and cons to any scenario, particularly with investing in general and specifically once you get into real estate. So guys, we're always going to talk about risk versus reward, you know, the amount of time that you have to spend versus the amount of money you can make, whether it's a short-term cash flow solution or long-term kind of buy and hold, long-term wealth creation. So we always talk about that here on the channel. We're going to dive back into sub twos today. Welcome to VIP Financial Education YouTube channel, where we help you go further, faster financially. I'm your host, Michael Matthey. Super excited about today's video. We're going to dive back in with a dear friend, Mr. Scott Ulmer. Welcome, Scott.
Thank you. Thank you for having me.
Yep. Always love having you here on the channel. So today we're going to take a different approach. So we've painted this in a pretty good light by design, guys. This is a phenomenal strategy for real estate investing, whether you are a newbie, somewhere in the middle, or a pro. If you want to add to your portfolio, specifically a long-term portfolio, this is a phenomenal strategy. You are targeting more distressed properties. So unlike Pink, for example, and we'll drop the playlist of Pink below, which is more of a high-end retail-based executive lease purchase strategy, then that is a no cost, no credit strategy. This does require a little capital up front. So let's talk about kind of the caveats. So we've talked about the pros. That's been on the previous video. What would be the cons be for an investor?
Yeah, so the cons for an investor that's looking to buy a house subject to is, I guess, a few things come to mind. First of all, there can be some expenses, and the expenses really could fall in a few ways. One is there is going to be a cost to transfer legal title, and with that comes some other costs, and there are ways to get title insurance around the mortgage. I won't get too technical on that, but you do have some costs up front, but you are, again, getting a free house, and so it's very, very justified. There also can be payments that need to be made current. Many times you can do that when you have a tenant buyer that is going to come in and give you a small deposit. You can usually catch up some payments, but there is a chance you can have some out of pocket. So that would be the caveat as far as the expenses. But I think the cons, and I've seen a couple of scenarios where an investor has taken the script, gone out and had someone say yes, and all of a sudden wow, somebody actually said yes to this, and what do I do now? And I'm going to go ahead and move forward with the deal. And so they go ahead and buy the house. They incur out-of-pocket expenses because somebody said yes, and then they take this house out to market, whether they're just trying to rent it or resell it or sell it to a tenant buyer. Now they find out that the house has a lot of problems, and maybe it's not as interesting to the market, and so they've gone out of pocket already. They now have title to a property, and now the property has some issues and some concerns. They probably didn't have to close on it until they took it to market to see what the market says. So we talked about this on a prior video. One of our philosophies in real estate is you negotiate the best deal you can, but you put it under contract, and then you go out and try to sell, rent, whatever your exit strategy is going to be. If you get negative feedback from the market, you can always go back and either back out of the contract, renegotiate it, and or somehow make it so it's a better scenario for you. I don't see people sometimes doing that in subject twos. They go ahead and close it and then take it out, realize there's a lot of problems. So the negative is that you can end up with a house that has some issues. So following the blueprint, if somebody does say yes, it's a great thing, it's exciting, but doesn't mean it's a great deal just because someone said yes to it. So I think the biggest negatives for investors would just be qualify the house, in the same way that you would if you were going to be buying it outright, because even though you're not laying cash, you are taking legal title. And so it's doable to just deed it back to somebody, but that's not necessarily a recommended course of action. So once you've bought the house, you own it, it's yours. I would make sure that it's the right deal for you, even if someone's willing to say yes to selling it to you subject to.
Yeah, and guys, we often talk here on the channel, do your due diligence, whether it's a housing deal, whatever the endeavor is going to be, go out there, do your research, crunch the numbers, do the math, right? It has to make mathematical sense in order to take it on. People are going to say yes to you, specifically if you're following a great script and a business model that is very effective in approaching those types of people. Getting a yes is not going to be uncommon. Getting the right deal under contract is what you're ultimately looking for. That way you don't have some albatross around your neck that you put yourself on the hook for. So if you want more information from Scott and his team on non-traditional investment strategies, go ahead and email pink@vipfinancialeducation.com. That's going to be pink like the color. But one of the things that you often teach, obviously during your trainings, is you might put a house under contract, a non-traditional or creative investing, or we can call it a number of different things, a contract there. Your exit strategy is not always going to be the same way you got into the deal, right? So you need to wait for the buyer's market to speak before you ultimately put yourself on the hook, is what you're saying.
It's like music to my ears, man. It's just the way it should be done. And again, everybody, there are other folks that train it in different ways, but it's exactly right. So we have really 8 different strategies at our disposal. All of them have some overlap, so it's not as if it's some confusing, set of different strategies. All of them have something that overlaps. No cash, no credit at the end of the day. But we like to put them under contract, give ourselves a window of time to close, and we always set the stage. There's some things we say to the seller, and I'm always real careful about that. I don't want anyone to think that we are reneging on contracts or we're somehow going back in bad faith and renegotiating. How we set it up with the seller, in most cases, it's not an unexpected if we have to come back and maybe renegotiate. But at the end of the day, what the buyers...
I think that's mostly due to the fact that you're dealing with, in this scenario, distressed properties.
Exactly.
They already, in most cases, know their situation,
yes,
right? And they're just trying to get effectively bailed out of it.
Yep.
So you go in, they're going in eyes wide open, you're shooting them straight, full transparency, full disclosure. Look, we're going to do the best we can. Let's get the house under contract. We're going to take it out to market, see what the market says, and then we're going to come back and find and put together the best deal effectively with the facts as we know them today.
Yep. And it may be different than you think going into the deal based on the response from the market. And to just tie your point down, that's something that makes exciting. It's creative real estate. Creative real estate really means you can put any terms that you can create on the table. And again, in our world, that's a lot of fun. That's what makes it exciting because nothing's off limits, right? And you can be as creative as you want, but depending on what the market of buyers tells you and what it says, that may change what you end up doing with the deal or how you end up exiting. And so that is exactly what we like, and it's just a great way to minimize risk and ultimately try to put the best deal together for all involved.
Got it. Okay, so we've addressed the investor. Now, if I'm a audience member right now watching this and I maybe am in that situation or could potentially be in that situation, what are the caveats? What are the cons for a homeowner?
Sure,
right?
Sure.
I'm transferring title, but I'm keeping myself on the hook for a mortgage.
Well, that's a huge. And so the cons would be, really the obvious. It's not even the elephant in the room. Why would someone do that? And the bigger problem is that most people don't know what measures of protection to give a seller. So if everybody going into the deal has the best intentions, but let's say that we'll just use a proverbial bus. You get you're the investor, you buy the home subject to, and you step out and you get hit by the bus, you're no longer here. What does that seller do? They don't have legal title, they don't have possession anymore, but yet they have obligation and liability on the mortgage. They're in a really bad spot. So if you don't know what measures of protection to give them in case you fall off the earth, you're putting them in a real bad predicament. So the obvious cons for homeowners in situations like this are they're giving away obviously all of their legal leverage at the end of the day. And so candidly, it's a great strategy for buying. I don't necessarily advocate it for selling unless you have measures of protection in place. And we have 2 that we give, but most people don't know what those are. And of course, people don't know what they don't know. So as a seller, you're never going to know what the protection measures are unless you're a real estate investor. And even even those don't know necessarily what it is. So very much putting yourself in a spot, without the right measures of protection if you're a seller.
What protection measures would those be?
Would love to share.
Talk about that. How does the seller, how does the homeowner that is on the hook for the mortgage still, that has transferred title, that no longer has possession of the home, how do they sleep all night?
Yeah, that's a great question. So first and foremost, we sell in a way that kind of paints both sides of the picture. We you mentioned in a prior, it's not always rainbows and puppy dogs, right? So
and ice cream.
And ice cream. I left out the best part. So, but we will tell a seller, what are the pros, what are the cons, and ultimately, if I'm in your shoes, these are the questions I'd want to ask you. You want to talk about building trust with the seller when you're telling them the questions they should be asking you. And so what we do as far as measures of protection, we give them two. Well, the first is what's called a wraparound mortgage. It's essentially a second mortgage that wraps around the first. There's ideally no payments, no interest. It's simply a protection measure that you're giving the seller now a mortgage that if you were to fall off the face of the earth, they can actually use that mortgage to foreclose on the property. Now, no seller that's behind in payments, giving you the house subject to, wants to then have to foreclose on you. What the heck is foreclosure, right? They're getting foreclosed. They don't know how to foreclose. So that can kind of go right over a lot of people's heads. But the second measure, which has gotten so many deals and almost, I don't want to say guarantees a yes, but it's the comfort level that they need to move forward, is I say this: Mr. Seller, at the closing, we'll have a deed prepared. You're going to be deeding the property into my entity. But I'm also going to have them prepare a second deed from my entity back to you with very, very simple instructions. It's going to be a deed held in escrow. So the deed in escrow is the second measure of protection. What the escrow language will say is that if I miss 3 payments consecutively because, let's say, I fell off the face of the earth, all you have to do is go down to the title company, show them that I'm 3 payments behind, they'll release the deed, and you can simply record that and bypass foreclosing me. So all of a sudden they're saying, okay, I'm losing all my leverage, if you will, and if this guy falls off the face of the earth, I don't have to track him down, find him, skip trace him, put a PI on him, and foreclose and incur $1,000 of lawyer's fees, of which none of those things make any sense to me. I just have to go get this deed and record it because he's missed 3 payments. That comfort level and that measure of protection has been a difference maker in almost all the sub-2s I've done. And so that is very much a nugget that most people are not aware of. I did a podcast for a national show about 2 or 3 weeks ago, and when I shared that, the gentleman who's been a 20-year investor said, "Wow, I've never heard of that. That's really," he was really thought that was a great nugget to share. So that is the measure. Those are the 2 measures of protection that we offer.
And guys, that's why we bring him here on the channel. You don't have to go out there and reinvent the wheel. This is super technical. So you're probably drinking a little bit from a fire hose right now. You probably have not digested a ton of this information, which is why we bring an expert like Scott here on the channel. So appreciate you sharing that. So we always want to paint the good, the bad, and the ugly. Obviously, those would be kind of the detriments for a homeowner that was looking to get into a sub-2 with an investor, but protection measures in place, give them those kind of warm and fuzzies, of course. Let's talk about the housing market in general. What cons could this potentially have on the housing market?
Yeah, I was thinking about that. So as far as, again, we mentioned this in a prior video that some of the pros for homeowner that might be behind the payments, selling the house to you or effectively giving you it subject to the underlying mortgage remaining in place, that stops it from a full-blown foreclosure, which ultimately becomes a record, and that's what people end up basing values off of. So values are based off of what other comparable homes have sold for. So if you have foreclosures in that area, ultimately that can have an adverse effect on the value as a whole. So if you're stopping that, by buying it before it goes into foreclosure, that is a good thing for values. The cons in that...
The neighbors are happy.
The neighbors are happy. They should be happy, right? So, in fact, what's really interesting, and this has come to mind 2 or 3 times, but if you're comping a house, you're not supposed to look at the low comps if it's not arm's length, which means a foreclosure is not an arm's length transaction. Arm's length means willing buyer, willing seller, normal transaction. So, but if you only have foreclosures to look at in your area, that's what the value is going to be based on. And we looked at a home, I don't know, it's been 2 or 3 years at this point, but literally of the 6 comps, like 4 of the 6 were all foreclosures, maybe 5 of the 6, and then the one was just not a good sale. So this person had a great house in a great area was really affected by the fact that there were several foreclosures in their particular neighborhood. So that's an adverse effect. As far as effects as a whole, if a seller ends up selling subject to, I don't know how that would would adversely affect the market. Again, there's going to be some corrections happening. It's been a very crazy market, as we talk about a lot. Unsustainable, obviously. Imbalanced is kind of the word that I've kind of come to use because of the supply-demand issues. But as a whole, I think that there are more positives and pros than there would be cons when you're doing these strategies. We want to do a win-win. We want it to be good for everybody involved. And so, as we've talked about, we don't believe in zero sum. We want to have win-wins. It doesn't have to always be a winner-loser. So I think as a whole, when these are done right, I think it can benefit everybody at the end of the day.
The good outweighs the bad.
No
if
question.
done correctly.
If done correctly, you bet.
Yeah, so it's super technical, guys. If you like information like this, you want to hear more about sub-twos, go ahead and smash that thumbs up button below. That's going to help our algorithms indicate to us that you want to hear more on this video series. We've got a few more coming up with Mr. Scott Ulmer, talking specifically about sub-twos. If you like information like this, you want to get involved in sub-two deals, you want support, then go ahead and we're going to drop a link below. Go ahead and email pink@vipfinancialeducation.com. That's pink like the color at vipfinancialeducation.com. If you're a subscriber, thanks as always for joining us. If you're not, go ahead and subscribe, tell friends and family. Always looking for like-minded folks here on the channel. And until next time, thanks for joining us and make it a great day, guys. What are your last couple deals? Let's go ahead and add them up. I've got the calculator in front of me right now.
Well, the last two deals were both FSBO flips. One of them was $38,000, and the other one was $27,000. I didn't expect that. It was unusual, but that was how it happened to be, because there were houses that was difficult for the realtors, and the realtors have tried it and couldn't make it work.
So between the two deals, yeah, $65,000 on those two. So a 38 and a 27, correct?
38 and 27.
And it cost you how much?
It only cost me, for one of the transactions, it cost me a transaction, a transaction loan that cost me $2,000, and then $1,500 for a legal fee. So that was $3,500 in all.
Got it. So just net, basically, I mean, you're still north of 60
yes.
on those two deals?
Yes.
Oh.
And I'm very humbled by it.
Are you upset?
No, no. I'm very humbled by it because I didn't expect it. Come on, we don't expect it. If I could get 10, 15, 5, I'll grab it any day for a FSBO flip, right? It just so happened the circumstances are, and we learn to articulate the best for all parties. In the end, nobody questions me how much I make or is unhappy because they're happy with what they're getting, you know.
Yeah, sure. Okay, so we're going to